Good afternoon, and thank you for joining us today. My name is Sil Flood, Chief Content Strategist at Morningstar, Inc. I'll be moderating today's discussion. First, I'd like to cover a few housekeeping notes. Sound for all attendees is muted. We will be taking questions via the QA chat box, which you should be able to find in the lower right-hand corner of your browser. The markets were caught flat-footed when citizens of the UK voted to leave the European Union on Thursday. While the crisis isn't nearly over, now that the dust has settled a bit, we want to take the opportunity to share with you the varying but consistent perspectives Morningstar has to offer in responding to this event, from asset allocation to macro to funds and stocks. Please note these important disclosures. First, the agenda. We'll briefly go over what just happened and talk about how this event is different from recent spikes in volatility. Then we'll hear from our Dan Kemp in London about the view from the UK today. We'll look at how U.S. funds have handled the crisis so far. Then we'll hear from our equity research expert about how Brexit is going to impact stocks, or has impacted stocks, in particular asset management firms. Then we'll answer the question, how is Morningstar advising its institutional investor clients? And finally, what are we urging investors and advisors to do? Next, I'd like to introduce our participants today. First, we have Tim Strauss, Senior Analyst from our Market Research Group here in Chicago with Morningstar, Inc. Dan Kemp, CIO of Morningstar Investment Management in Europe, joining us from London. Dan McNeil, Senior Portfolio Manager with Morningstar Investment Management, North America. Christine Benz, Director of Personal Finance with Morningstar, Inc. Stephen Ellis, Director of Equity Research for our Financial Services Industry Practice with Morningstar, Inc. And me. And with that, we'll get started. I'll hand it over to Tim Strauss to summarize what just happened. Tim, how is this bout of volatility different than what we experienced in August of last year and January of this year?
Well, thanks, Phil. The markets have obviously been on a wild ride these last 2 days, and what is, I guess, different about what's happened just in the last few days versus previous, bouts of volatility in the last, several years is that in this case the market was, betting very strongly for a Remain vote, and was completely surprised by the exit vote that came in. Whereas in the past, when we had bouts of volatility, whether it be relating to China's growth concerns, it was more of a situation where it was a buildup of people coming to a certain view, and if it wasn't all of an on-off type situation, it was a slow build to the volatility. Whereas here, we had very low volatility, and then we got the vote, which was very surprising, and then everyone wasn't really sure what to do, but obviously everyone did a risk-off trade and has been pulling back from generally all markets. We have seen somewhat indiscriminate selling of some areas of the market that don't necessarily have directly to do with the UK or even Europe in general. And we can, so that's in general where we're at today, is with the volatility. Now, moving on to the slide here on UK GDP, the United Kingdom has actually been one of the better economies in the European Union for the last several years. While this GDP growth on the slide is not fantastic by any means, it is above average for the economies of Europe. UK has taken advantage of becoming, well, has become sort of the financial capital of Europe, which now with this exit vote kind of puts a lot of that into question right now. So I guess I'd say is that for future projections of what's going to happen in the UK from a growth perspective, definitely it's a big negative for growth in the near term. Seems somewhat likely we might see a recession in the UK. How that impacts broader Europe, it's a little more uncertain because there's a lot more moving parts there. I think it depends on what happens with some of the more nationalistic views of in some of the different countries like France, if that kind of spurs them to have some instability because of this Brexit vote. So much more uncertainty when it moves to Europe. When we talk about UK exports, the largest trading partner of the United Kingdom is Europe, with Germany being 13%, France being close to 8%, Netherlands 7%. So this is a big question right now, because if you're going to leave the EU, you have to renegotiate your trade agreements, and it's very uncertain of how this is going to shake out. There's lots of talk about how maybe it'll be fine. They'll just kind of keep the status quo, but then there's other people saying that it could be very tough for the United Kingdom. So this is one of the big concerns, and part of the reason why we're seeing such big volatility in the UK market. This slide looks at government debt in developed markets, looking at U.S. Treasuries, Euro aggregate Treasuries, and UK sterling. And we generally say is that are Treasury bonds or government bonds good value right now? No, they're probably not a good value. They're at very low yields, and you could just basically across the board they're historically low yields. But what they do offer is diversification, and that is clearly seen in the last few days. U.S. Treasuries are one of the few asset classes that is actually positive on a return basis over the last few days. And by having some allocation to government bonds, it really gives a balance to a portfolio. So we still recommend maintaining an allocation to government bonds, mainly as a diversification benefit. This slide looks at the global yield curves of the United States, United Kingdom, Japan, and Germany. And I updated this slide actually just a few days ago, but it's considering how strong the moves have been in the Treasury markets, it's actually already out of date. The United Kingdom 10-year bond is below 1% now. It's on 0.9, 0.95, last I saw earlier today. And Germany, its 10-year bond is actually negative today, and Japan's is negative. What I'd say is, in general, we expect that yields across the yield curve will likely continue to move down. There's a higher chance that United Kingdom reduces interest rates soon, which will only put further pressure on the yield curve. And the United Kingdom started with higher yields than the rest of broader Europe. So there is more ability for yields to fall in the next several weeks. And as a U.S. investor, if you're mainly invested in U.S. bonds, that it also will push down yields in the U.S. because the U.S. has already had much higher yields than generally the rest of the developed world. So there's always a certain spread that at some point U.S. bonds become attractive to foreign investors if the yield is much higher than they can get in their local market. So as yields fall in the rest of the developed world, we would likely see the yields fall in the U.S. Next slide. And then finally, the currencies. The biggest moves we've seen in the market have really been in the currency markets. And this is a chart of the British pound versus the U.S. dollar. And you can see that, now this is actually is as of Friday. So again, the chart's a little out of date because the pound has weakened a little bit more. But you can see that the red line shows where we were on Friday versus history, and you see that we're basically at a period we haven't seen in the last 30 years. So the move in the currency was very strong, and many people are thinking that it actually will continue will continue over the next several weeks. And the main reason for this is that we have an issue with capital flows. So if you're going to leave the European Union, is foreign capital likely to invest in the UK in the near term? That's relatively unlikely. So you're not going to see capital move to the United Kingdom. And investors are already expecting that interest rates will fall in the United Kingdom. This fall in interest rates are negative for currencies. So all signs point to the U.S. dollar continue to appreciate versus the British pound. Also, the U.S. dollar has actually appreciated versus generally all currencies. It's appreciated versus the euro. It's appreciated versus emerging market currencies, and that's just more of a flight to safety. The U.S. dollar is the safe haven asset and during times of volatility, and we've seen that in the last few days, and we'll likely continue to see that as long as volatility is elevated.
Thank you, Tim. Dan Kemp from Morningstar Investment Management Europe. What's the view from the UK today, and what are you advising your institutional investment clients to do?
Good afternoon, Sil, and good afternoon, everyone. Greetings from the eye of the storm here in London. It's been, as you can imagine, a tumultuous few days as we've tried to get to grips with what is going on at the political, economic, and market level. And I think that's really the heart of this challenge that we all face now in dealing with Brexit, that it's not simply a market phenomena, but it's wrapped up in politics and economics. And as Tim mentioned, that creates incredible uncertainty, which is prompting some of these flows to safety, as he mentioned. So let's move on to slide 10, and we can illustrate this uncertainty there. Could we move on? Oh, brilliant! Thank you very much. What this slide shows is some economic projections, some changes in GDP as a result of Brexit from different sources. So there's a couple of things to note here. The first is that with the exception of economists for Brexit, who could be described as slightly biased in their outlook, all of these economists and economic bodies are expecting a decline in GDP. So, as Tim said, there's a sort of high likelihood of some form of recession in the UK over the coming months and even years. The key, though, is that the degree to which growth will fall and the severity of that recession is, as this shows, completely uncertain. So even amongst those that think that GDP is going to fall, you have a mixture of projections here from -3 to about -8. Now, in economic terms and subsequent market terms, that is a massive dispersion. And really, that's again the challenge we're dealing with, that the randomness that's associated with this event, and the incredible breadth of potential outcomes really can't be underestimated. There is a very wide range of potential outcomes from here. At the one end of the scale, we could see the UK adopting a relationship with the EU, with Europe, that looks very similar to the one we have today. On the other end of the scale, this could be the first act in the disintegration of the Eurozone and all that goes with that. And so really the first thing that we're saying to our institutional clients is that they have to wrestle with this uncertainty, this range of outcomes, that really it's a time to have very little confidence in your economic projections and think about that range of outcomes. And that's particularly important in Europe at the moment, because if we move on to slide 11, what we can see on this slide is that it's not just the UK that's going through political turmoil at the moment. Now, you'll be well aware, of course, of the UK election coming up in US election rather coming up in November. But equally, there's a French presidential election coming up next year. There's a German parliamentary election next year. There's a Spanish election over the weekend. And so what that comes down to is that 90% of EU GDP has an election within the next 2 years. Now, that 2 years is important because remember, under the terms of the Brexit, it's a 2-year window that the UK has to renegotiate the relationship with Europe. So an enormous amount could happen in Europe at that time. So what's the effect that we're already seeing? Well, I think Tim's gone through some of the main asset classes brilliantly before me, so I won't go through them again. But I think that the key is that the primary impact we're seeing at the moment is through the currency. And again, Tim gave the reasons for that. But one of the panics that I would emphasise is this potential for capital flight. That the UK is an economy that relies on capital from overseas, and so we are in a difficult situation. That if capital flows dry up, then potentially the Bank of England that controls our monetary policy, rather than lowering rates, as they clearly want to do, may end up having to increase rates. That is one of the range of potential outcomes that's available to us. So currency is likely to be very volatile and again operate within a wide range of outcomes over the next few months. We're seeing as a result of that volatility clearly a flight to safety. Tim talked about government bonds, and again we're encouraging people to think about those more as a hedge in this situation rather than a source of return. The way that our valuation-driven expectations work, we really don't expect a positive real return from government bonds over the next 10 years, but they are acting as a fairly effective hedge. Again, the danger in relying on that hedge is that if we have a need for the Bank of England to increase yields to protect capital flows, then we could really move into a period of positive real yields, which for those of you that remember 1994, a unexpected move to positive real yields is neither good for equities nor bonds. And then finally, equities in Europe. Again, we're seeing great dispersion here, where the large caps, the businesses with a great deal of overseas, particularly dollar earnings, have done relatively well over the last couple of days, while those companies that are more reliant upon the domestic UK economy have really suffered. And so we're beginning to see that dispersion in expectations within the equity market as well. And so finally, if we move on to the next slide, I've just put a few comments here from fund managers who are very highly regarded in the UK. You may be aware of some of them. Certainly, Michael Hassensab spoke at our conference in Chicago recently. And I'm not going to read through these comments. You can do that yourselves. But I think the summary of all of these comments is that while the long-term future of the UK economy is unlikely to be affected to a very large degree, it is really the uncertainty that's flowing from this event that's going to dominate markets, that's going to dominate people's thinking over the short term. And so I would just leave you with that thought that as we go into this next stage in the markets, it's really a time to prioritize research over reaction, and really to have a low degree of confidence in short-term predictions.
Thank you, Dan. And speaking of fund managers, I'd like to hand the reins to Christine Benz, Director of Personal Finance for Morningstar, Inc. Christine, how did the U.S. funds do on Friday?
Sure. Well, as both Dan and Tim have alluded to, we saw a strong rally in the Treasury market. The longer, the better in Treasuries on Friday, and that's happening again so far today, where investors were paid to take duration risk, in part because of the flight to quality that both Dan and Tim have alluded to, but also with the expectation that the Federal Reserve may not move too aggressively to raise rates, certainly in 2016, that the Fed will probably retain a somewhat dovish posture with respect to interest rates. So we saw treasuries come through as reliable diversifiers. One interesting thing to note, though, is that you didn't need to be taking a lot of duration risk with your treasury exposure, that even the Barclays Aggregate Index, which currently is about 2/3 government and government-related bonds, had a gain of about 0.65% on Friday. So you didn't need to be venturing into long-duration treasuries to get ballast from treasury exposure through an aggregate tracker. One thing we have on this slide and one thing we noticed is that municipal bonds have performed quite well. Obviously, they are insulated from the international economy. They're heavily reliant on what's going on with the domestic economy. And another thing worthy of note is that a lot of the issuance in the municipal bond sector happens to be long duration. So we saw munis benefit on Friday. My guess is that we will see them perform relatively well today as well. When we look at U.S. equity exposure, what we saw on Friday was pretty much across the board sell-off, where we saw the categories, the U.S. equity categories, feeling the pain pretty much equally. The typical U.S. equity fund lost something like 4% on Friday. We're seeing a little more discrimination so far today, and of course it's very early in the sell-off, but we're seeing small caps experience greater losses so far today. When we look at the other side of the ledger, some of the investments that haven't performed as well, international equity obviously has had a rough go of it. We see that the value-oriented international equity funds, these are the broad diversified foreign stock funds, those that have value strategies have generally underperformed. And this is for one of two reasons. First, many of these funds have heavier than average weightings in the financial sector, which has been hard hit. Another reason is that many of them had been feasting on European stocks because they perceive the values to be better in in developed foreign stocks, specifically in Europe. So funds like Oakmark International had a terrible day on Friday. Harbor International also had a rough go of it. In Oakmark's case, it wasn't so much that it is heavily exposed to Europe, but mainly that it had a big weighting in the banking sector and the financial sector. Harbor International is an example of a fund that had a big weighting in Europe and continues to have a big weighting in Europe. When we look at the alts categories, the liquid alternative investment funds, we see a broad disparity of strategies and we see a broad disparity of performance. So bear market funds, these are funds that typically are shorting U.S. equities, came through, although we wouldn't typically recommend them, certainly not for investors' long-term portfolios. We did see that they had a strong positive return on Friday. We also saw that some of the low volatility strategies that have become very popular in recent years performed well on Friday, as we would expect them to perform. Another category that we've been keeping an eye on is the group of funds called managed futures. These are funds that are somewhat trend-following funds. We saw that they had generally positive returns on Friday. AQR Managed Futures, which is one of our analysts' most highly rated funds within that managed future sector, had a 5% gain on Friday. So that is a somewhat promising category from the standpoint of diversification, but of course that liquid alts category is a very broad group. A couple of other side notes: when we look at active versus passive performance, when we look at the propensity of active managers to be able to beat their benchmarks, just an array of different statistics here on that front. Large cap value funds did a better job of beating their benchmarks, while large cap growth funds on average did not outperform their benchmarks. Another point worthy of note is that when we look at intermediate term bond funds, we see that the typical active intermediate term bond fund did not beat its benchmark on Friday. In fact, just 14% of active intermediate term bond funds managed to beat their benchmarks. Most such funds do tend to emphasize corporates more heavily than appear in the Barclays Aggregate Index, and many of them have been maintaining pretty short duration postures. A couple of other things to keep in mind as you look across your client portfolios: the Russell 2000 Index of small cap stocks was reconstituted on Friday. That arguably added to some of the volatility that we saw in the small cap sector on Friday. Another thing that we noticed is that emerging markets generally held up reasonably well, even though emerging markets have been under a bit of a cloud due to slowing growth over the past 3 years. We saw that the emerging markets equity funds, the dedicated emerging markets equity funds, were in line in general from a performance standpoint with U.S. equity funds and funds that have emphasized emerging markets, the diversified international funds that emphasized emerging markets also did not suffer higher than average losses on Friday. So again, it's early days during the current market sell-off. We're keeping an eye on some of these trends, but my guess is that if volatility persists, we will continue to see that high-quality U.S. bond piece act as ballast, and we will probably see some of the value-leaning foreign funds continue to suffer.
Okay, thank you, Christine. So it looks like some funds and asset managers are on edge. We have Stephen Ellis, Director of Equity Research for Financial Services Sector, here with us today. Stephen, how are we adjusting our views of banks, asset managers, and broker-dealers in light of these events?
Yeah, I mean, first, from an asset management perspective, I think that there's a couple issues worth noting. I mean, first off, as assets under management will be fairly volatile, for the asset management group, just due to the currency, stock, and bond market volatility. We would expect, fees to be certainly more volatile and probably lower over the short run. Over the long run, we do expect that, UK asset managers potentially will have to deal with increased costs due to operating in a less cohesive market. So we've noted that, we have reduced the valuations for most of the U.S.-based asset managers already in mid-January, and, we've held off, raising them back up again at the global market rally of the mid-February lows, given that, we were concerned about the potential Brexit vote. So, we've sort of incorporated that from an asset management perspective already. Although we do plan to certainly look at fair value estimates for, the group. From a capital markets perspective, similarly, firms with asset management and wealth management operations, would expect similar amount of volatility in those fee-based earnings streams. From firms that are potentially leveraged to rate hikes, such as brokerage firms, we would expect that they would have to wait a little bit longer before receiving an earnings boost related to higher interest rates. And we would also expect that, earnings that are denominated in European currencies would, certainly see volatility and potentially lower earnings there. One thing we do expect as well is that, given passport privileges in the EU, we would expect to see capital market funds potentially open up subsidies in the European Union to continue to enjoy trade privileges similar to what they had in the UK. Some additional capital may be locked up with regulatory requirements and, duplicate expenses, but, we don't necessarily see that as material, for the capital market group in general. One positive, we do see, for the group is, brokerages, exchanges, and financial information providers, we do see some benefits, just in terms of potentially more countries with their own currencies, and, monetary authorities with different interest rate policies could lead to higher volumes from currencies and wage trading volumes. And so, those firms would benefit, from those types of data points. And finally, from a bank perspective, we do have concerns about, the UK banks obviously this is a fairly disruptive event for them. We generally, we would expect to see, higher funding costs, particularly on the wholesale side, and, lower investment banking fees, lower asset management fees, and potentially trading losses given the substantial volatility we saw on Friday and certainly continuing today. Certain foreign banks that operate in the UK might also need to, move employees to other countries to facilitate, ongoing capital markets activity. And so generally, we see, risk for banks operating in the UK that operate the wholesale funding, that operate, large investment banking operations, and, rely on asset management fees. Although asset management fees we expect to be volatile, but we wouldn't necessarily see a significant long-term impact there. And that is the extent of my comments on the all three groups.
Okay, great. Thank you, Stephen. Now back to Christine Benz, Director of Personal Finance for Morningstar, Inc. Christine, what are you urging individual investors to do now?
Well, a couple of key things. One, I think the concept of risk capacity is really important. Many investors concentrate on their risk tolerance, how they feel about big losses during market shocks like the current one. I think it can help to refocus investors on the concept of how much risk can you tolerate without having to change up your plan. So for people who are young accumulators, they can actually tolerate fairly high losses or losses that are over an extended period of time without having to make changes to their plans. But people who are getting closer to retirement or already retired do have more limited risk capacity. If they suffer a big market shock prior to retirement or in the early years of retirement, that can have a big effect on the portfolio's viability over the person's anticipated retirement years. So I spend a lot of time counseling on that particular issue, knowing your risk capacity. In my travels, one thing I've become aware of is in talking to a lot of older investors, many of them are somewhat complacent about equity market risk. We have had 7 years of a fairly good market environment. As Tim said, volatility until recently had been pretty low. My sense is that a lot of investors have grown complacent with their equity risk. At the same time, their equity exposure has crept higher and higher. So one thing I like to talk about is that a portfolio that was positioned with 50% in stocks and 50% in bonds at the beginning of 2009 would now be about 75% equity, 25% bonds today. That's for a hands-off investor who hasn't made any changes. Meanwhile, investors are all 7 years older, and so there's a chance that their risk capacity has declined over that 7-year period. So I think that's an important point to make, that the value of setting money aside in high-quality bonds, in perhaps some cash, makes sense as you get closer to retirement. In terms of liquid reserves, I often talk about retirement portfolio planning. One of the key things I like to build into any model portfolios that I work on is a 1 to 2 year of cash, 1 to 2 years worth of cash cushion. This is 1 to 2 years worth of living expenses. The virtue of that is that the equity and bond markets can deliver some unpredictable actions, but the investor, the retired investor, knows that his or her near-term living expenses are set aside. So I think that's a crucial concept to talk about, the virtue of having liquidity. Liquidity may also be valuable for younger clients who may want to do a little bit of bargain hunting in the current sell-off, because as various speakers have alluded to, while it's not necessarily the nadir for stocks right now, stocks may eventually reach attractive points down the line, and clients who are in accumulation mode may like to do some buying. Another key concept, and this is one that we've hit on several times, is this idea of making sure that the portfolio has ballast. So making sure that if the client has bonds in the portfolio, that there's adequate exposure to high-quality bonds, which we tend to see, even though yields are pretty miserly currently, we tend to see them act as very effective diversifiers for equity portfolios in markets like the current one. Some investors may be inclined toward gold, given that we have seen strong performance not just during this sell-off, but so far in 2016. The risk is that it's impossible to value gold because it has no industrial uses. It can also be very, very volatile. In my experience, investors tend to add gold to their portfolios at exactly the wrong time. So for most investors, gold may be a very tiny part of the portfolio, but it's probably not a great time to add it when investors are feeling particularly defensive. And finally, a note about tax-saving opportunities. I think that they can be a silver lining in difficult markets. Investors may have some opportunities to do tax loss selling within their taxable accounts. One particular area of interest would be the foreign stock component. Many foreign stock categories down double digits over the past year. You may find opportunities where you can sell a given holding and swap into something similar, not identical, otherwise you'll trigger the wash sale rule, but something similar in complexion to maintain similar market exposure. So if you have, for example, a hard-hit active foreign large value fund, you might find another active fund with a similar complexion to its portfolio. Another idea on the tax saving front would be to take another look at Roth conversions. So converting generally be a better time to do it when the market is down versus when the market is up, because the taxes that you pay relate to the balance that you have in the traditional IRA. So that's another thing to consider for clients who have been mulling IRA conversions. It's generally a better idea to do them when the market's down. So those are my high-level thoughts about portfolio planning.
Great. Thank you, Christine. Finally, let's hear from Dan McNeil, a Senior Portfolio Manager for Morningstar Investment Management North America, about the posture of our institutional client portfolios before Brexit and how the team intends to address changes to the investment landscape going forward. Dan?
Okay, thanks, Phil. So we thought we'd start off with a little bit of positioning before the Brexit vote. We were somewhat underweight equities in most of our portfolios, and it wasn't necessarily because we were taking a position that the vote was going to be to leave. It was more driven by valuations, which is where we place most of the weight in our work. We viewed equities as being fairly to somewhat overpriced depending on the market, and so that's how we got to our somewhat underweight equity position. And frankly, we would have been more underweight in equities, but the very low bond yields are preventing us from finding many other very attractive opportunities outside of equities. So we feel a little bit constrained in what we think is somewhat of a low return environment going forward for investors, whether they're in equities or in fixed income. We have been moving our portfolios on the equity side away from U.S. equities and towards non-U.S. equities, both in developed and emerging markets. And again, that was largely driven by valuations. U.S. stocks have had a very strong run off the bottom, as Christine has mentioned. I think the S&P 500 is up about 250% cumulatively since it hit its lows in March of 2009. And just in round numbers, if you want to look at PE ratios, the S&P 500 is trading about 20 times earnings. The MSCI EFA index of foreign developed stock is trading around 16 times earnings. And emerging markets are trading around 12 times earnings, all on a trailing earnings basis. And those are pretty substantial differences, and we think it points to better valuations, cheaper stocks outside the U.S. And then finally, we've been underweight government bonds, again, just due to the low yield environment. We don't think there's much return potential there. So what's happening with the post-Brexit positioning moving forward, again, as value-oriented investors, we tend to find the best opportunities arise when fears are driving down prices. And so from that perspective, we would say that the sell-off hasn't truly been deep enough yet to justify large-scale buying opportunities within equities. If you just go back and look at some of the year-to-date numbers, you'd see that through Friday, The S&P 500 was still up 1% for the year-to-date period. The Russell 2000 index of smaller cap stocks was down just 2%. The MSCI EFA index was down 6%, and emerging markets were up about 2.5%, again, year-to-date through Friday. So that, to me, doesn't suggest a big buying opportunity in equities for those who are looking to be contrarians. And so I'd say that the past couple days have certainly been unsettling, but it's hard to say that there's suddenly great bargains across the global equity markets. That said, we are actively looking for areas of the market where there have been large losses and where those large losses appear to be out of line with our long-term valuations and fundamentals. And I think, as Dan Kemp referred to earlier, it's difficult to have some firm valuations when there's so much degree of political and economic change. But that's where we're spending our time with the analysis, is looking at long-term valuations and fundamentals, and then going back to compare and see where the prices are for those stocks and what that means for investors in the long term. And again, I think it's easy for people and investors to get caught up in the macroeconomic perspectives, but at the end of the day, we're investing in companies, we're investing in stocks, and those companies will have long-term earnings and cash flows, and that's what investors should be focused on. That's what we're focused on, and it's for that reason we're going to continue to look towards our valuation-oriented process. And again, just one last point. Government bonds are perceived as a safe haven, and clearly they have been in times of distress. But we think it's equally as important for investors to be forward-looking. And while government bonds have provided that stability in the past, going forward, we just don't think there's a lot of opportunity for investors, given the low yields. And there are risks being in government bonds, particularly interest rate risk. And while that might not be high on the list of investors' concerns right now, we think for people who have a 3 to 5 year time frame, that they need to look away from the assets that have performed the best over the recent 3 and 5 year period. So with that, I'll turn it back to Phil.
Thank you, Dan. So to summarize, the range of potential outcomes should not be underestimated. I think our remarks from Dan Kemp in London really underline that fact. We've seen funds respond normally so far. So yes, some of the indexes took a dip on Friday, but we haven't had any blow-ups or anything similar to that. We believe that while crises like these create opportunities, you should resist the temptation to react too quickly or with too much confidence in the wake of this outcome of the vote. And finally, prioritize fundamental research over reaction. Our investment management organization is seeking to uncover new investment opportunities that should improve long-term returns of client portfolios. So, for those of you who didn't hear it at the beginning, you can submit questions via the window in the lower right-hand corner of your screen. We did receive a number of questions during our remarks, and we will be sending slides to you as well as a link to the recording in the next few days. The first question we'll address is for you, Dan Kemp. Is there a chance of a new vote, a new referendum, or is there a chance that some of the EU mandates that the UK objects to will be lifted so that the UK doesn't feel so restricted by Brussels?
Thanks, Phil, and I think that's a really good question. And in fact, I think the second part of it is probably easier than the first, in that the evidence we have so far is that the EU is very reluctant to change any of the policies that has made the UK feel uncomfortable. We had some great evidence of that when Prime Minister David Cameron sought a renegotiated relationship with the EU back before the campaign started, and really came away completely empty-handed, which is what's kicked off the whole debate, really. So I don't think that's going to happen. The question on the new vote is potentially interesting. Europe has a history of not taking no for an answer. So there have been various treaties over the last 20 years where they've been voted down by by individual countries, only for the countries to be given another opportunity to vote, or for those votes to be overturned. Now, that's somewhat different from an exit, so I don't think we can draw firm conclusions from that, but I think there is a chance that there will be some form of political manoeuvring in the background. I think it's probably more likely, though, that the UK government would negotiate a new relationship that looks similar to the existing EU relationship. That would seem to drive a position through the middle. But there's certainly a lot of rhetoric around at the moment saying that the EU is not going to accept that. It's just worth mentioning that this exit has to go through Parliament first, and of course the majority of parliamentarians are still anti-Brexit. So there's lots of potential barriers in the way of this actually happening, but I think most people are proceeding along the basis that it will happen. But that's, as I say, far from certain at this stage.
Okay, thank you, Dan. Another question from a participant. This one's for Tim Strauss. How likely is it that the Fed will cut rates, and in what circumstance could that happen? How likely is it for the U.S. to fall into negative yield territory?
Well, I think what is clear is that the Fed is not going to raise rates in this environment, so we can kind of stop talking about that. So in the near term, I would expect them to likely just keep rates where they are, and there is always the potential that they not in the near term, but maybe definitely further out, that they could cut rates again. They don't want to do it, though. I mean, this Fed really does want to get to more normalized interest rates, but events outside of their control are really making it almost impossible for them to do that. So so as far as potential for falling rates, I mean, I think it's out there. What are the chances of negative yields in the U.S.? I mean, it's definitely not off the table. I mean, we would never have, a few years ago, you never would have even considered it, but I think it definitely is. It is a potential outcome out there. Definitely not going to predict that, but with yields going negative, with the 10-year yield in Germany being negative right now, you definitely couldn't say the U.S. couldn't happen in the U.S. too.
Okay, thank you, Tim. This question is from Scott W. It's for Dan McNeil with Morningstar Investment Management, North America. Do you still prefer non-U.S. equities over U.S. equities? Is it still a valuation story?
Yep. Okay, so we do think that non-U.S. equities are still more attractive than the U.S., and it is still due to the cheaper valuations in non-U.S. equities. We think that the additional losses, particularly heavier outside the U.S., continue to point us in that direction. And of our investing principles, while we're valuation-driven, we're also long-term oriented. And so what that does for us is it relieves some of the pressure to make some of the shorter-term calls on whether a vote in a particular country is going to go one direction or the other, or what the immediate responses to uncertainty like this are going to be from governments or central banks. Having a 3 to 5 year view says that we're going to be around to endure some additional losses in assets that we think are unduly beaten down, because we think there will be an eventual recovery and security prices return closer to their intrinsic value. So that's where we're focused on, those long-term valuation opportunities. We're not focused on the next turn in markets, either up or down, and trying to make that call right, because we think that's particularly difficult to do, and that the odds of success tend to be very hit or miss from that type of perspective. So we're focused on the long term, remain focused on valuation, and we do think that valuations are cheaper outside of the U.S. today.
Thank you, Dan. And perhaps, let's see how much time. We have time for a few more questions if you want to submit. Christine Benz, you may not be able to answer this question, but here it goes. Do you have any observations about U.S. high-yield bonds and bond funds?
I did not look at their performance.
We lost your audio there.
Okay, so this is Dan McNeil. I'll jump in here. We seem to have lost Christine momentarily. But we tend to be more constructive on high-yield bonds at the moment. We've talked about how low the yields are on government bonds. I think it's somewhat of a controversial position in the industry now. Some people, because of the duration of the recovery, while it hasn't been strong, think that we're coming to the end of the credit cycle and that the next move down will be towards higher default rates and high yield, and that will lead people out of the high-yield market. We tend to think that the trouble spots in high yield are more contained to the energy and mining parts of the market, and we don't see broad spread contagion to other industries, and spreads are still somewhat wider than normal. They're not quite as wide as they were earlier this year when there was a sell-off in stocks and high-yield bonds in the first few weeks of the year, but we still think that investors are getting a fairly decent yield from the high-yield space, given the paltry returns that we're expecting from both stocks and government bonds. So we think it's a somewhat of a happy medium for investors who want to take some risk, but maybe not as much risk as taking full-on equity positions.
Yeah, this is Stephen Ellis. I would just add, actually, we've also actually seen higher credit costs from private label credit cards as well as auto loans. So those are some of the problem areas that we
So a bit of a counterpoint here, Dan. Is Europe a value trap right now?
I think yes, that's a really interesting question. So let's start by defining what a value trap is. And in our minds, a value trap is a situation where you don't get a reversion in valuation back to previous norms. And so that tends to happen when you have a significant fundamental break in the outlook for an asset. And so as we look at Europe, then certainly there has been a significant fundamental change at the country level, at the political level, and so as Europe's gone through a fundamental change, then that needs to be taken into account. That's not the same, though, as saying that the underlying assets, that the companies within Europe have gone through that same break. Again, it's worth remembering that Europe has a wide range of very high-quality, well-capitalized companies, and so I think it would be wrong to say that Europe is a value trap. I think there's every reason why valuations for good companies will revert to long-term norms, and we'll be looking for opportunities in that market as in other markets, as Dan said, over the next few months. But equally, it's worth saying that in the short term, it may well look like a value trap. It may look like something that investors put money into now, and then it falls significantly from here. And that's not really a value trap, but that's sometimes how people perceive it. And so that's why, as we start looking for opportunities, we're most focused really on those assets that have suffered collateral damage as a result of Brexit, but aren't have limited fundamental damage, and really it is a sort of valuation change. Whereas European equities, UK equities, and the local bond markets, they are right at the heart of the storm, and we're not going to get some clarity on the long-term fundamentals there for some time. So that's a very long-winded way of saying that I don't think that European assets are a value trap, but that's not the same as saying that investors should aggressively buy at this point while there's so much uncertainty.
And I guess I'll just follow up with one point, and that is the word uncertainty keeps coming up again, whether you're talking about Morningstar commentary or commentary from other managers. And this should be obvious, but uncertainty is part and parcel with investing in markets, and it's not there's never a time when there's no uncertainty in markets, and there's time when people feel maybe less uncertain about markets, but perhaps those are times when asset prices are at their all-time highest and they have the most room for them to fall. Usually when there's feeling of great uncertainty in markets, that tends to be times when prices are lower and valuations are cheaper. And for people who do have a long-term fundamental value target on an asset class, if they have the right research backing up that opinion, those are the times you can most often make good returns in markets. It's not waiting for the uncertainties to go away and then decide to invest in markets.
That's absolutely right. I'd completely agree with that. Yes, when people feel the certainty, there's normally overvaluation, and so there's these periods of uncertainty do create fantastic opportunities for the long-term investor.
Okay, I think we have time for one more question, and I think it's for Dan and Dan again. What is your position on hedging, currency hedging?
Yeah. I think currency, maybe I'll give the U.S. view, and maybe I'll let Dan Kemp answer from a U.K. perspective. Currency has certainly been a topic that's been coming up more and more often as we've been coming off of a multi-year period when there's been a dollar appreciation. And when we have a case of a long-term appreciation in the U.S. dollar, it typically means that investors' assets or their investments in foreign-denominated currencies are going to be losing value as the dollar appreciates relative to those foreign currencies. And so that usually brings calls to have hedged strategies on the apparent belief that, again, whatever has been happening recently will continue on indefinitely in the future, and that tends to be, we think, a losing strategy for investors, is to look at what's happened in the past few years and make those same projections in the future. So while investors can look back and say, over the past 3 years, it would have been good to have your currencies hedged against the appreciation of the U.S. dollar, that might not be the case in the next 3 to 5 years. And so we generally take currency diversification as one additional layer of diversification that is built into our portfolios, and that means sometimes we'll be hurt by those foreign investments when the U.S. dollar is strong, but we expect that we'll pick that back up when the U.S. dollar depreciates and foreign currencies rise. So it's not clear that being hedged or unhedged is a winning strategy for long-term investors, because it does tend to balance out over the long term. Dan Kemp, I'll give you the...
Yeah, Dan, thank you. I completely agree with that, and obviously we adopt a similar approach. I think where we think about currencies the way that we think about other assets, we have purchasing power parity valuation models for currencies as well. So we have a view on currencies, and where we see that combination of attractive asset prices and an attractive currency valuation, then we would tend to take an unhedged position. Where that's less clear, where the currency may look expensive or at fair value, then we're more likely to take a hedged view. So it is really an asset by asset, long-term value-driven view, rather than a policy view about always being hedged or unhedged.
Okay, great. Thank you. And with that, our webinar is concluded. We thank you for joining us today, and thank you to the panelists as well. Have a good afternoon.